Welcome back to the deep dive, where we really try to unpack these earnings calls and figure out, what's going on beneath the surface. And today we're dialing into Traeger, specifically their Q4 2024 earnings call.
Yeah, definitely a lot to dig into here. We'll be looking at the numbers, of course, but also trying to understand the broader strategy, the trends that are impacting them, and ultimately trying to figure out, is this a company that's set up for success going forward?
Okay, so let's start with the headline numbers here. Revenue for the fourth quarter was up 3%, so not a huge jump, but when you break it down, their grills business saw a pretty significant increase, up 30%. And their consumables also did really well, up 25%.
Right, and I think that's what immediately catches your eye, right? You've got these two core segments, the grills themselves, and then the recurring revenue from consumables, and both are showing really strong growth. So that suggests there's still healthy demand for that core Traeger experience.
And you're right, that 3% overall revenue increase, it's kind of hiding a more interesting story when you look at those individual segments.
Exactly. And it's not just about the top line either. When you look at the profitability, their gross margin improved by 410 basis points in Q4, and their adjusted EBITDA, that jumped up by 41%. So they're not just selling more, they're also doing it more efficiently or finding ways to improve their pricing, which is a good sign.
Definitely seeing that efficiency play out.
Yeah.
And that momentum seemed to carry through the whole year. For the full year 2024, grill revenues were up 8%, which actually beat their initial expectations. And the full year gross margin also expanded by a lot, 540 basis points, with adjusted EBITDA growing by 34%. So those are some pretty solid numbers.
Yeah, no doubt. And I think if you take a step back and look at the bigger picture, these full year results really point to a strong turnaround, or at least a significant recovery, in their core business. That margin expansion throughout the year is especially notable. It suggests they're managing their costs well and maybe even benefiting from, strong brand loyalty that allows them to maintain favorable pricing.
Okay, so looking ahead, they've given some guidance for fiscal year 2025. They expect revenue to be between $595 million and $615 million. So that could be anywhere from a 2% decrease to a 2% increase. And adjusted EBITDA is projected to be between $75 million and $85 million. What are your thoughts on that outlook?
Well, it's a bit of a mixed bag, right? On the one hand, you might expect a little more than flat to slight revenue growth after such a strong year. But on the other hand, that adjusted EBITDA range suggests they're still very focused on maintaining profitability. And, we have to remember, they specifically mentioned that this guidance doesn't account for the potential impact of new or proposed tariffs, which is a big unknown right now.
Right, that tariff situation is definitely hanging over a lot of companies these days. Okay, let's go back to that 30% growth in the grills business in Q4 for a second. They highlighted a couple of key drivers there, the new Woodridge series, and better retail sell-through, especially during the holiday season. What's the deeper story there? What made the Woodridge series stand out, and what shifted in their retail strategy?
Yeah, so with the Woodridge series, I think the initial success indicates they're doing a good job of innovating, either by hitting a sweet spot in terms of pricing or by offering features that customers are really looking for. And then the improved retail sell-through, particularly the fact that Black Friday was one of their biggest sales days ever, suggests that their marketing and promotional efforts are really working. They're getting people in the door and converting them into buyers, especially during those crucial shopping periods.
Yeah, a record Black Friday is definitely a strong signal. And you mentioned pricing earlier. It seems like their strategy of offering more accessible price points is also paying off.
Absolutely. The fact that their lower priced grills performed so well shows that there's a lot of demand for the Traeger experience, even at a more budget friendly level. That's really important for expanding their reach and attracting new customers who might not have considered Traeger before because of the price.
And to keep that momentum going, especially with those new customers, what are they doing to engage directly with consumers?
Well, they're planning to more than double the number of Costco road shows they do in 2025, which is a pretty smart move. Costco has a huge, loyal customer base, and these road shows give Traeger a chance to really educate people about the benefits of pellet grilling and show off their products. That can be super effective, especially for people who are new to the whole concept.
Okay, let's shift gears to the consumable side. A 25% increase, it's pretty impressive. It suggests a pretty loyal customer base, right?
Oh, absolutely. The fact that they're seeing increased replenishment of both their core pellets and the seasonal blends tells you that people are using their Traeger grills and coming back to buy more fuel. That recurring revenue is a huge asset. It provides a much more stable foundation for the business than just relying on those initial grill sales.
And they made a pretty big move in terms of where you can buy those consumables. They started selling pellets and rubs in select Walmart stores in December. How significant is that?
I think that could be a real game changer. Walmart has such a massive footprint, and by entering that market, they're reaching a whole new demographic. And their research suggests that this Walmart customer base doesn't overlap much with their existing channels for pellet sales, so it's a really strategic way to grab additional market share.
Okay, so the core business seems to be doing well, but their accessories segment, specifically Miator, had a pretty rough quarter. Revenue was down 24%, which is a bit alarming. What happened there?
Yeah, the underperformance at Miator is definitely something to watch. They actually increased their marketing spend in Q4, but they didn't see the demand lift they were hoping for, and their return on ad spend was lower than they expected. So that suggests there might be issues with their marketing strategy, or maybe they're facing tougher competition in the smart meat thermometer space. It's also possible that the overall category growth is slowing down. Maybe the initial novelty of those smart thermometers is wearing off for some consumers.
They did mention increased competition and higher advertising costs because of the election cycle. Do you think those are valid explanations?
I mean, those are certainly factors. The smart thermometer market has gotten a lot more crowded, and we all know advertising costs can skyrocket during election years. But the fact that they didn't see the expected demand even with more spending, that does raise the question of whether there are also some internal challenges with Miator, maybe product-specific issues or brand perception that need to be addressed.
So what's their plan to turn things around with Miator?
They're taking a multi-pronged approach. They want to optimize their marketing spend, so make sure they're targeting the right customers more effectively. They're also making some leadership changes within the Miator organization to bring in fresh ideas and strategies. And they're rethinking their product roadmap to ensure they're staying ahead of the curve in terms of innovation and competitiveness.
Are they also looking to expand distribution for Miator like they did with the Consumables, just to make it more visible?
Yeah, they see expanding retail distribution as a big opportunity for Miator, and they've already launched it in select Walmart stores. But they're being realistic in saying that it'll take time for all these changes to really take hold. They're actually forecasting continued softness in Miator's results throughout 2025.
Okay, so turning back to the overall 2025 outlook, that low single-digit growth expectation for grills seems a little conservative, especially considering how strong Q4 was. Why aren't they more optimistic?
I think it's a combination of factors. They're definitely being cautious given the uncertain macroeconomic environment. When the economy is shaky, people tend to hold back on big purchases like grills. And they're also facing tougher year-over-year comparisons because they had those increased promotions and the initial Woodridge launch in 2024, which gave them a big boost. So they're balancing their excitement about the brand with a realistic view of the economic headwinds.
And they're still expecting growth in consumables to continue, right?
Yeah, those recent distribution gains, particularly the move into Walmart, should continue to drive consumables revenue in 2025. That recurring revenue stream is a real bright spot for them, especially in a potentially volatile economy.
But it sounds like the weakness in accessories will probably offset some of those gains.
Yeah, that's the likely scenario for now. Until they can turn things around with Miator, that underperformance in accessories will probably continue to weigh on our overall growth.
Okay, let's talk about the bottom line for a minute. Their gross margin is expected to stay relatively stable. What are the key factors there?
Well, they're expecting continued benefits from their supply chain efficiencies and improvements in their pellet margins, which is great. But that's going to be partially offset by a shift in their sales mix. They're expecting to sell a higher proportion of their lower margin grill models, which could put some downward pressure on the overall margin. So it's a bit of a balancing act.
And they mentioned that they're increasing employee compensation, specifically cash bonuses. How will that affect their profitability?
Yeah, they're anticipating about a $7 million increase in cash compensation, which is mainly due to a shift from equity-based bonuses to cash bonuses for certain employees. Now, the total compensation expense is staying about the same, but this shift to cash means more money going out the door in bonuses, which directly impacts their adjusted EBITDA. It'll be interesting to hear more about why they decided to make that change.
And it seems like Q1 2025 might be a bit softer than what we've seen lately.
Yeah, they're projecting a year-over-year decline in both revenue and adjusted EBITDA for the first quarter. They attribute that partly to the timing of revenue recognition related to their direct imports, but they also point to the uncertainty around tariffs, which can really mess with the timing and volume of orders.
Speaking of tariffs, that's the big question mark for so many companies right now. Traeger's guidance doesn't include any potential impact from tariffs. Why is that?
It all comes down to the uncertainty and the constantly changing nature of trade policy. It's really hard to predict when and how new tariffs might be implemented and what the exact impact will be on their costs and consumer behavior. So they're basically saying that it's impossible to give accurate financial projections right now because of that volatility.
But they did acknowledge that a significant portion of their products are sourced from China. How much are they potentially exposed?
Yeah, about 50% of their sales come from goods that are imported from China. So they definitely have significant exposure if tariffs are imposed on those goods. That's a key risk that investors need to be aware of and keep an eye on.
So how are they planning to deal with this tariff uncertainty and minimize the potential damage?
They've outlined a few strategies. They're going to keep looking for efficiencies in their supply chain to absorb some of the cost increases if tariffs do hit. They're also talking to their contract manufacturers about potentially sharing the burden. And if all else fails, they might have to raise prices for consumers, which is always a last resort.
It's interesting that their consumables and most of their accessories aren't so exposed to those China tariffs. That could be a real advantage for them.
Yeah, that's a good point. The fact that most of their pellet consumables are made in the US and most accessories are sourced from other countries, that gives them some insulation. Those are their higher growth segments, so it could make their overall performance more resilient to tariff pressures compared to companies that rely heavily on China for all their products.
There's also been a change in their leadership team. Their CFO is stepping down. What's the story there?
Yeah, Don Blossel, the current CFO, will be leaving after they file their Q1 2025 10Q. It seems like this is a planned succession, though. Joey Horde, who's currently their Senior VP of Finance and Strategy, will be taking over as CFO. Smooth transitions in key roles like this are always important for maintaining investor confidence.
Okay, so zooming out a bit, what's Traeger's take on the broader grill market right now?
Well, they believe the overall grill market has probably bottomed out after those declines we saw in the past few years. They're expecting modest growth in 2025, somewhere between flat and up 1-2%. But again, they're very cautious about the potential impact of tariffs, which could throw those projections off.
And despite a potentially flat market, they're confident they can still gain share.
That's right. They said they actually gained market share in the grills category during 2024, which means they're outperforming the overall market. That suggests their brand is still resonating with consumers, and their products are standing out even in a challenging environment.
They also mentioned that the market hasn't fully recovered to pre-pandemic levels. What does that mean for future growth?
Well, they're basically saying there's still room for the market to grow as people replace their old grills and demand continues to recover. They think it could take another 12 to 36 months to fully catch up to those 2019 levels.
It seems like price sensitivity is a big factor for consumers right now.
Yeah.
What have they learned from their pricing strategies?
They specifically highlighted the success of their Pro 22 promotions last year, where they were selling it for $389. They saw a huge response to that, which tells them there's strong demand for their grills at that sub $500 price point. It gives them valuable data on how price sensitive their customers are.
So they'll probably keep offering a range of price points going forward.
Yeah, that seems to be the plan. They're going to keep offering grills at accessible price points to appeal to that budget-conscious segment. And they see their new Woodridge series, which is priced at a premium but still relatively affordable, as a good step-up option for people who want to upgrade from the entry-level models.
Okay, last question, I promise. Their inventory levels were up at the end of Q4. Is that something to be concerned about?
Well, the increase is mainly due to them stocking up for the peak grilling season and getting those new Woodridge grills into the pipeline. They say they're comfortable with their current inventory levels and believe they're in a good position to meet demand. They also mentioned that they're trying to bring in inventory early in Q1 2025, just in case those tariffs hit.
And how's their plan to diversify their manufacturing outside of China coming along?
That's been an ongoing effort for them for a few years now. They have a second manufacturing partner in Vietnam that's scaling up really well, and they expect to start mass production there in Q1 2025. Right now, about 25% of their grill production is in Vietnam, and they can increase that if they need to. So that gives them some flexibility and helps to hedge against those potential tariffs and any supply chain disruptions.
Okay, so to wrap things up, what are the key takeaways you'd share with someone who's trying to figure out if Traeger is a good investment based on this call?
Well, the big picture is that their core businesses, grills and consumables, are performing well. They're seeing healthy demand, and their strategies in those areas seem to be working. But the challenges with their accessories segment, specifically Miator, are a definite concern. And then you have the uncertainty around tariffs looming over everything. They're taking steps to mitigate the risk, but it's still a big question mark.
Yeah, that contrast between the strong core and the struggling accessories is really interesting.
Definitely. The success they're having with grills and consumables is a good foundation, but whether they can turn Miator around and navigate those potential tariffs, that's going to be crucial for their future performance.
All right, so now for our This Is Not Financial Advice segment, where we put on our speculation hats and brainstorm some totally wild, but maybe kind of plausible trade ideas based on what we've learned.
All right, so given how strong Traeger's consumables business is and how well they've done expanding into Walmart with that unique customer base, here's an idea. What if you went long on Traeger and then shorted a competitor that's mostly focused on selling grills and doesn't have a strong recurring revenue stream from consumables?
Okay, what's the logic there?
The thinking is that if the economy takes a downturn, that predictable recurring revenue from consumables could make Traeger a more attractive investment compared to a company that's relying solely on big-ticket grill sales. That difference in revenue stability could cause their stock prices to move in opposite directions. Of course, this is just a thought experiment, not actual investment advice.
I like it.
Okay.
Hit me with one more wildcard idea.
All right, so remember how Miator is struggling right now, and they're expecting it to stay soft through 2025. But they're also saying they believe in the brand long-term and are working to turn things around. So what if you bought a long-dated call option on Traeger, basically betting that Miator will eventually make a comeback?
So you're basically saying ignore the short-term pain and bet on a Miator revival down the road.
Exactly. It acknowledges the current challenges, but speculates on the possibility that their efforts to fix Miator will pay off further out. If they can pull it off, it could be a huge boost for the stock, and that long-dated option gives you time for that to happen. But again, this is just a speculative idea, definitely not financial advice, and it carries a lot of risk.
Well, those are definitely some interesting ideas to chew on. That was a deep dive into Traeger's Q4 2024 earnings call. We covered a lot of ground, from the key results to the strategic initiatives they're working on and all the challenges and opportunities they're facing.
Hopefully this gives you a much clearer picture of where Traeger stands right now and what their prospects look like going forward. What were your biggest takeaways from this conversation? What questions are you still thinking about? As always, we encourage you to do your own research and due diligence before making any investment decisions.
And be sure to join us next time on The Deep Dive, where we'll be dissecting another earnings call and bringing you those key insights.